In last week's video, I demonstrated how to obtain a copy of your Check My File credit report, how to break down the information that is contained inside it, and how this information might impact a lending decision when it comes to applying for a mortgage. In this video, I'd like to dive into the different types of bad credit, because bad credit is quite a broad subject. Now, each kind of bad credit can be things like CCJs, defaults, IVAs, debt management plans, and simple things just like late payments. You might have also been previously bankrupt. Hello guys, my name's Chris Duncan and I'm a qualified mortgage broker based in the UK. On this channel, we help provide the very best mortgage tips for anybody looking to get a mortgage. If you're new to the channel, then please think about subscribing. To recap, in the previous two videos, we've covered what bad credit is, where I would start if I was looking to apply for a mortgage in 2023, and how to obtain a copy of your Check My File credit report. Now don't forget, this is a multi-agency credit report, so it shows us everything that all three credit reference agencies hold on you. So it's really important we get this right. Now when we talk about bad credit, it's quite commonly referred to as adverse credit. There's also a stigma attached to speaking about it, and there really shouldn't be, because you wouldn't believe the amount of people that have actually got a little bit of bad credit. Just having a late payment on a mobile phone bill is deemed as bad credit. Now it isn't really bad credit, is it? Let's be honest. It could just be simply an admin error. Now on the opposite side of that, we speak to people frequently that have been through bankruptcies, IVAs and debt management plans, and all these people are able to get a mortgage and can be helped. Sometimes it isn't straight away, and we'll give them an action plan to go away, rectify the things that they need to do or put certain things in place, and then they can come back to us and we can help them obtain a mortgage. One of the worst things you can do if you've got bad credit is bury your head in the sand. Tackle it head on. Let's get stuck into it in 2023 and see how we can help you achieve your goals of becoming a homeowner or remortgaging your property. Let's talk about the 6 types of bad credit. Now let's start with the most basic, late payments. Now they pretty much are what they say they are. They're just late payments. So you've got a set date of each month where you make your direct debit payment, and let's say you go over this date, that would be deemed as a late payment. Now the maximum amount of late payments you can get are 6. Once you go to a state 6, the lender will then file an application for a default. Late payments are payments that are received after the due date, or not at all in some circumstances. Now when you look at your credit profile, each status that you have will be down as settled currently, and for each payment that you miss, you will get a 1, 2, 3, 4, 5 and so on, up to a status 6. Now when you get to a status 6, there isn't a status 7. A lender won't contact you for 30 days while they file an application to put the account into default. On month 8, the account will then sit at default. Now quite often, the consequences of falling into this trap are often fees and interest rate increases by the lender. It will also have a negative impact on your credit score. Now remember, credit score isn't everything, and the odd late payment might not make too much of a difference, but if you're frequently missing payments, it will have an impact unfortunately, and it will dictate which lender you're able to go to. Now next up, defaults. What is a default? Well, as I've previously explained, a default is when you've missed 6 consecutive payments, the lender's given you the 30 days grace period, and then on month 8, it then sits at a default. Defaults can apply to any credit account, whether that's a loan, credit card, car finance, sofa finance, mobile phone finance, any type of finance can fall to a default if you miss enough payments. Now again, you can incur fees, interest rate increases and penalties from a lender if you fall into a default. Now a default really will impact a lender's decision when it comes to getting any type of finance, whether that's a credit card, car finance or a loan. Because what the lender's looking at is they know before you've gone to a status 6 and then on to default, they understand that you've missed 6 consecutive payments and you've ignored all of the reminders that you've had from the lender to make the payment and bring the account up to date. Now, that being said, you can get a mortgage with a default regardless of its value and whether it's settled or not. You are able to do this, but it will dictate which lender you can go to and the monthly payments because they're going to charge you more in the way of interest to mitigate that risk. Now, as we've previously mentioned, certain companies will ignore defaults below a certain value. Now, quite commonly, this is £300. Now, the high street unfortunately won't do this, but some of the subprime lenders will. Now, next in line, CCJ. So, you've gone through the late payment process. Your account's then gone to default. After the default process, the lender has the option to take you to court. Now, you don't physically have to stand up in court, and sometimes they'll just send you a letter to say that this is going ahead, and you have the option to defend yourself. But quite commonly, people don't attend these court hearings. So it's quite common to see people with CCJs for small trivial things like parking tickets, sofa finance, mobile phone bill arrears. Now, that being said, a lot of lenders don't actually progress it to CCJ stage due to the cost. So it's quite common to see somebody with a £500 or £600 default that never actually goes to CCJ stage. Now, the same as CCJs, we are able to get you a mortgage with a CCJ, but again, your interest rate will be impacted, the amount of lenders that you're able to borrow from will definitely be impacted, and the fees that a lender might chase you for to recover the costs will also be included in that CCJ. A CCJ might also give the creditor access or permission to come and seize goods to the value of the CCJ amount, including their cost of recovery. So this is something that you need to be really, really careful of. Now, that being said, before you go out there and start satisfying your CCJs, please speak to a mortgage broker first, because believe it or not, sometimes having a CCJ unsatisfied versus satisfied won't actually make a lender's decision. Speak to the broker and explain what you're looking to do, what you want to achieve, and let them come back to you with an action plan on how they can make this happen for you. Now, debt management plans. Debt management plans are voluntary. So let's say you've got various amounts of expenditure per month and you're struggling to make those payments. Quite often, you're able to get some free advice from Citizens Advice, and they might point you in the direction of a debt management plan. Now, these are often put in place by debt management companies, and it is an agreement between you, the debt management company, and the creditors to pay a certain amount each month. Now, quite often, they will look at reducing or freezing the interest on the debt management plan to give you the ability to catch up and make these payments. Now, quite often, a debt management plan will last between 3 and 5 years. But don't forget, any credit profiles that you have on your report will sit there for 6 years after they've been settled. Ultimately, a debt management plan is designed to help somebody get back on track and make the payments back to the lenders. Now, next up, IVA. An IVA is an individual voluntary agreement. Now, this is something that you put in place if you just can't pay back the creditors. So let's say you've exhausted the option of a debt management plan and you just think, I'm not going to be able to make those payments. I'm really, really struggling. You can come up with an IVA. Now, again, these normally last for around 5 years, and your payments will be broken down into consecutive payments that are more affordable to you. Now, with an IVA, quite often some of the debt can be wrote off because this is an agreement with the lender, but you've made an effort to pay some of it back. Now, it's unlikely you'd go into an IVA if you've only got £2,000 or £3,000 worth of debt. These are normally for significant amounts of debt where you're unable to get yourself back on your feet, and it will be means tested by the company that put it in place. And finally, bankruptcy. Now, bankruptcy is the worst one of them all from a lending point of view. It's looked at the worst. And why? Because all of your debts will be completely wiped. Now, again, these are managed, and you will have to go through the courts and an official receiver to see if this is even possible. There's often fees associated with actually putting yourself through the bankruptcy, and then when it comes to getting a mortgage, quite often you're going to need 25 or maybe even 30% in the first couple of years anyway. After you've been into the bankruptcy for 12 months now, you are deemed as discharged, which means you're good to go and get a mortgage. But the lenders that will do this charge a significant amount of interest rate, because imagine you've borrowed somebody money in the past and they didn't pay any of it back. They just went to court, had it all wrote off. Would you lend them money? So yes, there are companies that will lend them the money, but they will charge you a significant amount of interest rates to get you back on track. Something to be aware of when you go through bankruptcy is it's quite often to see people lose assets. So if you've got a home, they may take this from you. If you've got expensive cars, they can take these. If you've got expensive jewellery, they may seize these. And all this is to recover the costs that have been written off and try and recoup some of the costs to the lenders. Now, we've looked at all 6 kinds of bad credit and the potential pitfalls when it comes to applying for a mortgage. But it's important to understand, I strongly believe that there is a lender for everybody out there, pretty much. But there's something you need to consider. First of all, monthly cost. Now, people get frustrated with this because they think that because we can get them a mortgage, it's going to be cheap. Now, it isn't. As I've explained previously, anybody with bad credit poses a bigger risk to a lender. So the lenders are going to charge you more for this. So you can expect your monthly payments to be higher than if you was to go to, let's say, Halifax. Now, this one's really frustrating. People obsess over interest rate, and really it doesn't matter. What matters is pound and pence. What is it going to cost you each month? How long is it going to take you to pay that mortgage back? Don't obsess over the interest rate. If you've got bad credit and you're sat in rented accommodation and home ownership is an ambition or a dream of yours, then the interest rate isn't relevant. What's relevant is the monthly cost and whether this is affordable for you going forward. Don't forget, just because the interest rate's high, you won't be sat there forever. We'll put you on a credit repair scheme. Additional documents. Now, this one's overseen by quite a lot of people. Again, if you've got bad credit and you're looking to get a loan or a mortgage, you can expect the lender to ask you for more documentation. Why? Because they want to understand that you've got all your ducks in line. They want to make sure that your employment's solid. They want to look at your spending habits over maybe a longer period of time. They want to make sure you fit criteria with them. I hope this video has given you an insight to the different types of bad credit out there and the effects that they will have on a mortgage application should you wish to proceed with one. Thanks for checking out this video. I hope the information contained in it has been helpful, and if you have any comments then please leave them in the comment sections below and I'll come back to you. If you haven't already, then please think about subscribing and I'll see you in the next one.